Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to see how 2013 wrapped up for industrial real estate in the U.S. We'll look into the show's crystal ball, if you will, to see what we might expect for property level performance and cap rates moving forward. We'll also talk about the numbers, of course, but we'll also look behind the curtain. Well, please welcome my first guest, Rene Circ, Director of Research Industrial with CoStar, U.S. leading commercial real estate research firm. Rene, thanks for joining us today.
Yeah, happy to be here.
Well, thank you, sir. And to get us started, how did the industrial market perform in the U.S. in 2013?
The market performed very well. But before I get into the entire year, I need to give a special holler to the fourth quarter, assuming you can holler at a quarter. And that is because we saw 45 million square feet absorbed during that quarter alone. And that places is the sixth strongest quarter on record. So that doesn't feel like this slow recovery that we've been having. That was actually a very strong quarter.
That's amazing.
But focusing on the year itself, that was fine. It was good. 124 million square feet absorbed, which compares to 84 million square feet before. So that's about a 50% increase year over year. That's very strong. But, to put it in perspective, 162 million square feet was absorbed at the peak in 2007. So, we still have about a quarter to come back. Now, vacancies are phenomenal. 7.6% is our reading across the PPR 54, which is essentially our nation. And that is a lower point than any other time in the last cycle. So to put it differently, one needs to look back all the way to the internet bubble years to find vacancies that are lower than where we just ended up the year of 2013. So that's excellent. And of course, supply is the culprit here. There's been very little delivered, only about 70 million square feet delivered in 2013, which is less than half of what would be normal for the size of the market we track. We track about 10 billion feet. So when you put it all together, what do you end up with? You end up with a market that has actually strong rent growth. And rents in 2013 grew about 4.5%. But if you think of markets like Dallas, which historically don't have rent growth at all, we saw much stronger numbers. Dallas, for example, was 6.8%. There's one more interesting concept here, which is we've developed this little index which looks at how widespread the rent growth is. And we essentially are comparing the number of markets that are this is a sub-market basis, the number of sub-markets that are experiencing growth versus not. And the ratio now is 3 to 1. So for those who are not good at math, that's 75%. And that means 75% of all sub-markets, and we track about 2,000 sub-markets, are seeing rents rising. That's unbelievable.
Yeah, that's a good news. That's incredible for the economy and, of course, everyone involved in the commercial real estate world. So do you expect this trend to continue into 2014?
Yes, especially on the rent side. On the sort of occupancies and vacancy side, 2014 will be a transition year. Given the supply pipeline that is still pretty low, we are tracking just under 100 million feet under construction today. Vacancies will fall another 50 basis points. So we'll end the year probably in the 7-1 territory. But at the end of this year and the beginning of the following year, vacancies will start to rise as developers who've been standing by idly way too long are definitely coming back. So rents will grow. It will be definitely a widespread recovery in rents because we are not at the previous peaks yet, at least not in all markets. But vacancies are going to start flattening out, and then year 2015 is going to be where actually some work is going to have to be done.
Well, that's still pretty positive for 14 and good news. What about sales volume and cap rates, Rene? What did you see in 2013?
Well, we don't have all the numbers from the fourth quarter yet across the country, especially in the markets and non-disclosure markets. It takes a little bit of time to collect. But based on preliminary numbers from the fourth quarter and obviously full year, the year is going to be up in sales volume, about 22%. So that's what we have now. There's more trades to still come in, so maybe it will be 25%, maybe even more than that. year over year. So that is very strong. And to put it in perspective, that compares favorably to essentially all the other property types. Multifamily is up 14%, office 17%, retail only 7%. So this is definitely becoming the year or the couple of years of industrial, which, I'm industrial, I'm not complaining. But to put it once again in perspective, the market is still about 15% below the 2007 peak. But even here we can come up with a positive story, and that is that 15% below peak level is on a dollar basis. If you look at square feet that are being traded, so in other words, the activity in the market, we are actually at all-time highs. 2013 will end up above 2007 in terms of the number of square feet, or total sum of square feet that traded. So activity is very strong, and we're essentially seeing a lack of sales versus a lack of buyers. Now on the cap rate side, when you have strong demand and not enough supply, prices get pushed up, or in other words, cap rates get pushed down in this case. And we are seeing cap rates at all-time lows. And this is the case in more and more and more markets. This is not just a Miami and Southern California, maybe Houston and Seattle story. We are starting to see it in more markets like Pennsylvania, for example, like Dallas. The spreads between Dallas today and L.A. are probably the lowest they've ever been. So capital is starting to fan out into more and more markets, and I expect that to just continue in 2014.
So can you give us a prediction for cap rates for 2014 and how they might adjust in the industrial sector?
Well, cap rates are low. I mean, that's no doubt. But so are interest rates, and there's still a lot of room in the spreads. So I'm actually not expecting any meaningful rise in cap rates in 2014. One of the reasons is what I already discussed, which is there's way too much capital chasing potentially too few deals. But also interest rates are now rising. If you look at the forward curve, and that's actually what we look at when we think about where could cap rates go in the future, since the taper began, so essentially beginning of this year, the forward curve has fallen 30 to 40 basis points. So today interest rates are 40 basis points lower than they were at the end of last year. So the taper was a lot of fear, but it is not materializing in higher interest rates. That doesn't mean higher interest rates won't come, but the other good thing here is that this time around interest rates are going to be rising because of a stronger economy and not necessarily because of fear of inflation. And what stronger economy does, it compresses risk spreads. So even if we look beyond 2014, we don't expect a meaningful increase in interest rates, in cap rates, even though interest rates may rise, because cap rates will offset that increase.
Okay, and we're talking with Rene Circ, Director of Research with CoStar. And Rene, what's making industrial so hot today, or if you will, what is hot in the industrial space? Is there certain areas or property types that you see are hotter than the others?
It's the whole market. We have more and more clients wanting to get into the space. People who have historically just done office or multifamily. We are getting a lot of calls about, I want to be in industrial. And the change that we saw in 2013 has been, it's not only about the big building. The smaller spaces are coming back. And the other thing I'm expecting to see in 2014 is that there are going to be more developers. There are going to be names that historically were potentially in the industrial space, but they were mostly acquirers. And now, especially when cap rates are this low, they're starting to look at, well, maybe building my space. In special markets like Lehigh Valley, maybe even Dallas, where there's land and pricing is above replacement cost now, there are going to be more developers in the market.
So you expect to see a lot more construction starts in 2014?
Absolutely.
And
with new names attached to them.
New names and new markets?
And definitely new markets. I mean, it started in Southern California, but now it's getting pretty widespread. Still low numbers. I mean, we're still 100 million versus what would be normal for this size of the market, 160 million underway at any given point. But that 100 million is way more than 40 million this time last year, so it's coming.
Well, Rene, you've given us a pretty bright outlook for industrial, so we appreciate it, and thanks for joining us today.
My pleasure to do it.
Thank you. And if you'd like more information from Rene Circ and CoStar, visit CoStar.com. We'll stay with us in a moment. We'll have more intel on the industrial market, including a look behind the curtain with a participant who's very active in the space. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.